Lately, the stock markets have been down. The stock market has been hit by waves of recession, which have caused the whole market to crash. Stock values are on the downtrend. Strong companies like Twitter are laying off their staff. And even the crypto market is experiencing what many have dubbed the crypto winter. But even in times of uncertainty and constant bear markets, like the current global recession, there is always a chance to make huge money by investing carefully in dividend stocks. After careful research and analysis, we believe these are some of the 5 best dividend stocks to buy now. If you haven't subscribed to our channel, make sure you click on the like and subscribe buttons and stay till the end of the video because the last stock we're sharing is our favorite, and we think you'll like it best. Now, without further ado, here's our first pick. Qualcomm. Most Americans use Qualcomm products without even knowing it. For those who don't know what this company does, Qualcomm is a telecommunications company that specializes in producing semiconductors, software, and other services related to wireless technology. The first company that should come to mind when you see the 5G or 4G signal on your internet-enabled phone should be Qualcomm. With a total revenue of around $44 billion, the company's revenue has increased by over 30% from the previous year's revenue, which is a pretty impressive feat. The COVID-19 market meltdown was not kind to Qualcomm, as the biggest producer of smartphone processors experienced a drop in stock price due to a general reduction in phone demand as the pandemic rocked the whole world. In March 2020, the company experienced a year low when its stock price plummeted to around $60. It then experienced a turnaround as the stock price rallied to about $188 in January 2022. Qualcomm's stock price is approximately $125, down by more than 30% from its all-time high in January 2022. Qualcomm recently partnered with Samsung to produce its 5G Snapdragon processors.
So we're really now able to launch that our platform on Samsung devices globally, and that's a multi-year agreement.
This means a steady cash flow and relevance for the company, as Samsung has 21.8% of global smartphone users behind Apple, with 50%. With a dividend yield of 2.3% and an average 4-year yield of 2.5%, Qualcomm is trading right around its average yield. The company's dividend payout ratio, which is currently set to 25%, is still in the normal range. It looks like Qualcomm won't stop paying dividends anytime soon. Qualcomm also has an impressive record of years of dividend raises, as it has experienced growth in dividend payments for 18 consecutive years. The dividend and EPS growth rates for QCOM over the last 9 years stood at 13.3% and 14.4% respectively. This stock has experienced steady growth, which, if you ask me, is a positive trend. According to our estimates, the dividend and EPS will continue to increase, but with a reduced growth rate of 8% and 4% respectively. Over 9 years, Qualcomm saw an average return on invested capital of 24%, and you can see the return on capital has grown hugely, from 19% in 2012 to over 42% in 2021. This double-digit return on capital can be seen as a sign that the company is doing great things for investors. At the current share price of $125, our model estimates that Qualcomm stock offers a 23.6% annual return over the next 5 years. We think Qualcomm stock looks to have tremendous return potential, making it an attractive dividend stock. Walmart. Walmart is an American multinational retail store operating in over 24 countries around the world. It is the largest retailer in the world, with over 230 million customers weekly and generating around $570 billion in revenue annually. With a workforce of about 2.3 million people, Walmart ranks as one of the largest employers in the world. Walmart specializes in wholesale and retail products such as groceries, electronics, clothes, toys, home furniture, household essentials, and pets. As an American, it is almost impossible for you not to have used a Walmart store to buy foodstuffs or furniture after moving into a new apartment. The COVID-19 recession was a period of uncertainty for almost all stocks, but because the company could handle online orders and delivery, it still made a net profit over the course of the year. At the height of the COVID season in March 2020, Walmart stock was about $120 before hitting a maximum price of about $157. After going through so many highs and lows, Walmart stock is currently valued at around $152, close to the maximum high it reached during the pandemic. Following the recent release of its third quarter earnings, Walmart stock increased. WMT reported an adjusted earnings per share of $1.50 in the third quarter, representing 3.4% year-on-year growth, far exceeding guidance for 10% declines and the $1.32 consensus estimate. The unexpected 8.7% revenue growth management had previously guided for 5% growth was critical to that beat. Walmart appears to have strong brand power for value, which is paying off in the current environment. Walmart's U.S. operations saw 8.5% growth in net sales, which was helped by 8.2% growth in comparable sales. Operating income increased by 4.8% as WMT passed on inflationary costs to customers. Walmart's dividend yield has been around 2% on average, but today's dividend yield is about 1.5%, which is less than usual. Even though the dividend yield is a little lower than average, Walmart has also lowered its dividend payout ratio, which means the dividend is safer. The payout ratio is now below 40%, which means that dividend payments are well covered by earnings. Walmart has grown its dividend payments to shareholders for an impressive 48 consecutive years. Walmart is on its way to reaching Dividend King status when a company increases its dividend payments for 50 consecutive years. Over the past 9 years, Walmart has averaged a 1.7% annual earnings per share growth rate and a 3.5% annual dividend growth rate. You can see that the return on invested capital started to dip, but Walmart has been turning it around. Return on capital has averaged 13.5% over the past 10 years, and today it's up to 15.6%, which means that Walmart earns 15.6% on every dollar that investors invest in the company. At the current share price of $152, our model estimates that Walmart stock offers an 8.4% annual return over the next 5 years. We generally like to get a double-digit annual return, but hey, this is not a crypto coin or an NFT. This is buying a stock in one of the most stable businesses in the world. This is an outstanding dividend stock to own, and it certainly wouldn't be a bad stock to start a position in if the share price heads down. Walmart's competitive advantage stems from its massive size, which allows it to buy and ship products at scales that no other company can match. This enables it to operate at low consumer prices, and because groceries account for more than half of its revenue, its performance during the recession was excellent. Walmart stock has a 5-year price target of $181, which signifies very fair growth. With a 5-year annual return of 7.8%, the stock is okay for a safe and defensive stock with an A dividend risk score. After thorough research and analysis, WMT has a reasonable dividend growth rate, a fair EPS growth rate, and a decent return on capital. This makes the stock one you can focus on as a standard, low-risk dividend stock that looks to offer a good return. Big Lots. Another amazing stock that you should take a look at is Big Lots. Big Lots is also an American retail company with over 1,400 stores in 47 states. Big Lots has been around since 1967. Like Walmart, it sells everything from food and drinks to toys and electronics. With total revenue of $6.15 billion, Big Lots is a fast-growing retail company whose stock has risen. During the lockdown with COVID on a rampage in 2020, the company was severely harmed. Unlike Walmart stock, which did well during this period of recession, Big recorded one of its lowest performances to date, with its price reaching as low as $12 in March 2020. The stock bounced back as everything returned to normalcy, recording an impressive price of around $70 in March 2021. Big stock is now priced at about $18. This is low compared to the stock's previous performances, but as with the general market, the best time to invest is when a stock is down. The dividend yield on Big Lots is 6%, which is one of the highest in the retail industry. This is excellent, considering the stock is currently more than 60% down from last year's high. But the stock may be riskier because it has seen negative earnings, so the payout ratio is currently negative. Big has an EPS growth rate of about 4.9% and no dividend growth rate. The company has not been growing dividends, but has a 7-year consecutive history of paying dividends. Based on our research and market analysis, the dividend growth rate is projected to be around 5% annually in the next 5 years. It is also worth noting that the annual EPS growth rate that we project the stock will see over the next 5 years stands at negative 2%. Although the company hasn't grown its dividend over time, it has a good record of return on investment. The stock has an average return on the total investment of 17.6%. This value has been relatively constant over the years. Big currently trades at around $20, and there's expected to be a turnaround soon with the company focusing on improving its gross marginal profits. Our model estimates a total return of 20.5% annually, which is good. Still, this is a more risky stock with negative earnings in recent quarters and a short dividend track record. Lowe's, COS. If you are looking for a new stock for your investment portfolio, one option you can explore is retail stocks. Lowe's is an American retail company headquartered in Mooresville, North California. The company specializes in home improvement. With over 2,100 stores in the U.S. and Canada, Lowe's is the world's second largest hardware chain. The company boasts an annual revenue of about $72 billion and has over 300,000 employees. Lowe's stands out in a very competitive retail space with its strong relationship with its customers. In March 2020, the company's stock recently experienced its lowest price trend after hitting $66 during the height of the COVID-19 pandemic. After the pandemic, the stock hit an all-time high of around $260 in May 2021. Lowe is currently valued at around $210. Lowe's stock is considered cheap in its valuation given its impressive return to investors and stakeholders. The stock had its highest dividend yield in 2020, with a dividend yield of around 3%, and the dividend yield has averaged about 1.75% over the past 5 years. Today, the company's dividend yield aligns with its historical average, hovering at about 1.75%. Although the company has a dividend yield of 1.75%, its dividend payout is equally low, balancing the dividend yield. This means that the company can quickly pay out dividends. The stock's payout ratio is currently around 27%, which is also fair. Lowe's is also a dividend king after 58 years of consecutive dividend growth and payment. You can see that the stock is very stable, with a laudable balance sheet and impressive margins. Over the last 9 years, Lowe has had an excellent dividend growth rate of 22.8% and an EPS growth rate of 25.4%. We project that over the next 5 years, the annual dividend and EPS growth rates will be around 10% and 6% respectively. You can see that the return on invested capital has grown tremendously for Lowe's, up from just under 10% in 2012 to a staggering 46.7% in 2021, averaging 21.3% over this period. After careful analysis of the company's growth and other factors that can influence its stock value, our model suggests that Lowe, currently priced at $211, will yield around an 11.2% annual return over the next 5 years. This makes the stock look like a viable long-term investment option. It's offering just over 10%. It has a crazy dividend track record as a dividend king, and this is a vast business growing all over America. Lumen Tech. At the top of our list today for attractive dividend stocks is Lumen Technologies. American telecommunications company Lumen Technologies offers security, cloud solutions, voice services, and other services. Lumen has been around for quite a long time, having been founded in 1930. The company has an annual revenue of around $20 billion. It is safe to say that Lumen is one of the biggest companies around when it comes to communications and network services. Lumen was also a victim of the recession that hit the stock market due to the COVID-19 pandemic, and it wasn't until 2021 that the company fully recovered. During the pandemic, the stock dropped to around $9 before it rallied to about $15 in July 2021. Lumen stock is currently valued at just under $6. Lumen stock is currently one of the most controversial stocks in the market after its recent financial report. However, the stock might be on its way to a price reversal. The stock dividend yield today is around 17%. But keep in mind, Lumen has announced it is cutting its dividend, even though the dividend payout ratio is not too high at around 50%. Since Lumen is divesting part of their business, management thinks it's best to cut the dividend to invest more into growing the business. According to our analysis, the EPS growth rate has averaged around 2.4% over the last 9 years, and it is expected to keep growing annually at a rate of 3% over the next 5 years. Dividends are expected to fall to around 20 cents per share over the next few years, so this will be a big haircut. Lumen stock has experienced steady growth in return on capital. In 2012, the ROI was 3.7%. This grew to 7.1% in 2021, averaging 4.7%, with Lumen stock currently priced around $6 per share. Our model estimates this stock could offer a 16.4% annual return over the next 5 years. Of course, this is a more risky stock. Earnings per share of the stock are expected to fall since the company is divesting non-core pieces of the business, and that means management expects to cut the dividend to better invest in the company. This stock pick might not be for investors who are really looking to play it safe, but it might be interesting for investors who believe in the turnaround story. Thanks for watching. Share your favorite stock pick down below in the comments section. Hit the like button and subscribe to the channel if you haven't, and we'll see you next time. Have a good day. Cheers.